Hello and welcome to the Week in Markets. Today I'm joined by Matt Henderson, Portfolio Manager, and we're going to explore the key events of this week in terms of economic data, but also the market reaction. I suppose we should really start at the start of the week where the markets were digesting the latest comments from the Chair of the Federal Reserve, Jay Powell, from last Friday, where he gave his strongest signal yet that the Federal Reserve are ready to cut interest rates in September. Why is that? Well, it's because the risks around inflation have diminished and the risks of unemployment rising have increased. So the question really is whether they're going to cut by 0.25% in September, or will it be a 0.5%? I suppose we've had data this week both on the growth side but also on the inflation side, which can help us gauge which one it's going to be. So Matt, perhaps we can start thinking about and exploring the growth data. What did we learn this week?
Yeah, thanks, Paul. So US GDP has had its second revision. So normally with GDP releases, there's a couple of revisions or iterations of that report before we get to the final confirmed number. So what we've actually saw is quite positive for US growth. So originally, the estimate was 2.8%. That's been shifted higher up to 3% for the US. So just offer some context and a bit of comparison. The UK's last numbers were for 0.6%. So quite a wedge between US growth and what we're seeing here within the UK. And really, within that data, we can see what's driving that higher assumption for US growth. And it's really down to the consumer. So we saw consumer spending increase by 0.6% within the latest revision. So that comes, in the face of higher inflation that the US consumer has gone through and also higher interest rates. So just continuing to see that theme of the US consumer remaining resilient despite some of these other pressures that they're facing. And then, go on, Paul.
No, I was just going to just cut in there. That's, I suppose, a number of economists had been forecasting a recession last year, this year, expecting the consumer to be tapped out given higher interest rates and a drawdown on excess savings. But if you've got economic growth in the US running at 3%, seems like we're quite away from a recession, and perhaps suggests that the Federal Reserve may be a little bit more patient and gradual with interest rate cuts going forward. So maybe a 0.25% cut rather than a 0.5% cut next month, given the progress on economic growth.
But what would take the counter argument to that, I guess, is what we saw with the inflation data today. So we had PCE inflation, which is the Fed's preferred measure of inflation, and we saw the theme of disinflation continue. So headline was 2.5 and core was 2.6, so a slight miss on core, headline as the market expected. But we're continuing to see inflation come down within the US, which, as you said at the start, that inflation pressure for the Fed has started to subside and they're starting to think more about supporting growth within the US.
And I suppose if you think about the market reaction to that inflation data, it's been slightly more positive for equities. Bonds have sold off a little bit, as you'd expect, but I think the market's more concerned or I've got the growth picture in focus rather than the inflation picture, which is very much different to what we've had over the last few years. I suppose if we turn attention to Europe, where we've had, a whole host of data on the inflation front from all of the major countries within Europe, so Germany, Italy, Spain and France. On the whole, it's been better than expected. So in Germany, Spain and Italy, inflation has come in below expectations, really trending around that 2% level, which really should give the European Central Bank, the ECB, the confidence to lower interest rates again in the coming months. If we look at what the markets are expecting interest rates to be lowered in September, and then another 1 or 2, 0.25% cuts by the end of this year. So equity markets in Europe have been taking that well, and that's been positive for us as multi-asset investors.
Yeah, and I think the US has seen a similar theme where by the year end, markets thinking about 4 rate cuts, but it believes that the fall in inflation will be persistent throughout 2025. So looking at about 9 rate cuts from where we are now come year end 2025. So markets believe that central banks globally have really got inflation under control now.
Super. So I suppose if we now turn attention to companies, and we've been going through this earnings season where companies have been reporting their Q2 earnings in terms of revenues, earnings, but also giving guidance in terms of the management's expectations for the company going forward. I suppose the last big company to report, which reported this week, was the company that's really at the forefront of AI technology, Nvidia. Matt, what happened?
Yeah, so actually beat analyst expectations for revenue and earnings, but I think some of the things we talk about in these videos and our podcast is just the importance of valuations for markets, in terms of if you pay too high of a valuation for something, it doesn't matter if it's the greatest company in the world, you could still experience a loss. And that was somewhat of what we saw with Nvidia. Despite it beating those estimates, that wasn't quite good enough for the market, so it actually Shell's share prices fell after it reported those earnings. I think also the market was also a little bit concerned about some of the reporting it made around its next generation of chips coming through, where they've just talked about wanting to tweak their production process to increase the yield of chips it's producing. But I guess what we've saw afterwards, after the close of trading, is actually shares have rallied again as investors start to think about the potential that AI could have going forward.
Yeah, and it wouldn't be the first time this year that Nvidia's reported, had initial sell-off and then recovered.
And the market's bounced back after.
And I think it's just perhaps worth just reflecting on equity markets and bond markets over the course of August. It's been far from an oasis in markets this month, but we have seen equity markets rebound after somewhat of a volatile first week of August. And it's quite impressive to see positive returns for the month from Europe, the US and the UK. So really those messages that we were giving at the start of August of trying to be, just to give a bit of perspective of what's happening in markets, having confidence in our advanced diversification approach, using active managers to help navigate through this, but really keeping an eye or focus on that long-term goal and a time horizon that most investors have. It has really paid to just be patient, and we've seen equity markets recover. We've seen positive returns from most fixed income regions. So we've seen US government bonds, positive returns, US high yield, positive returns, gold is up. And we've actually seen a recovery in the pound as well. The pound is up over 2% as we've seen stronger growth come through the UK economy side as the US side continues to show solid growth but normalising, and that's really helping support the pound. That's everything from us today. Thank you, Matt, and thank you all for watching. If you do like the content, then please subscribe and like.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.